This was Bitcoin's turning point, and almost nobody recognized it. Price looked shaky, fear spread throughout the market, ETF outflows climbed into the billions, and miners felt real pressure. On the surface, it looked like a system losing its footing, but then something deeper moved. Quietly, structurally, and without announcing itself. Moments like these appear only once a cycle. They're rarely obvious at the time, and you usually notice them later, when everyone begins to reprice around them. And that's what this episode is about. Not the fear, not the candle. The moment the foundation shifted while everyone else watched the noise. I'm gonna walk you back to the day the flip could have taken place, piece by piece. And by the end, you can decide for yourself whether this was the start of Bitcoin's next chapter. So let's begin with the detail almost everyone missed. The turning point had an exact date. December 1st looked unremarkable. No rally, no fireworks, no breaking headline. But then again, cycle shifts rarely start with spectacle. Underneath the calm, the market experienced its first moment of relief in nearly 2 years. The Federal Reserve's quantitative tightening program, roughly $40 billion a month draining out of the financial system, finally hit zero. When QT ends, nothing explodes, but something stops, the leak. The system goes from losing liquidity every month to holding steady, and that alone changes the entire backdrop. From there, the next question becomes almost inevitable. When does the rebuild begin? Because if you zoom out, every tightening cycle follows the same rhythm. First comes the pause, therefore the next phase turns into stabilization, and eventually, whether they call it QE or smooth functioning, liquidity returns to the system. The vocabulary changes, but the direction doesn't. So while Bitcoin looked range-bound, nearly $90,000, the deeper structure had already shifted. December 1st wasn't a loud event. It was a quiet reset, one of those inflection points that only makes sense in hindsight, once markets begin to reorganize around it. And that reset leads directly into the moment we're all in today, because now everyone is waiting on Powell. So you see, the market isn't wondering whether QT is over. That part is done. What everyone wants to understand is what comes after. History already outlines the answer. When balance sheets stop shrinking, they rarely sit flat. They begin adapting to the needs of the banking system. And we saw this after the 2019 QT period. We saw it again in the early pandemic responses. And we're beginning to hear early confirmations now. Fed Governor Williams recently noted that reserves are expected to grow over time as part of maintaining smooth operations. He didn't call it a stimulus per se. He didn't label it QE. But then again, the market doesn't trade labels. It trades flows. That's why this moment matters. December 1st plugged the leak. The FOMC meeting now decides the tone of the environment built on top of that new floor. And the tone moves markets long before policy does. So let's zoom into that moment. A 25 basis point cut feels like background noise. Markets expect it. Traders already priced it in. The real signal comes from Powell's posture. He doesn't need to promise anything dramatic. But if he speaks in the language of ample reserves or sustained liquidity or smoothing functioning, the most complicated language I know, the market will hear exactly what it needs: flexibility. And that's the pivot. If Powell sounds calm and confident, risk assets usually lean into it. If he sounds tight or cautious, pressure stays in place. This meeting sits directly on top of the December turning point. The drain ended. The floor formed. Now the question becomes how quickly the refill phase begins. But that's only part of the story. Something else shifted this past month, quietly at first, then unmistakably. And it came from the sector that shaped this entire cycle. That is, the AI trade hits its first major stress test. CapEx concerns escalated, export restrictions spooked investors, doubts formed around how sustainable hyperscale spending truly is. That wave triggered a sharp sell-off in AI equities, and crypto took collateral damage. But then, something unexpected unfolded. The narrative didn't collapse. It rotated. Google's Gemini 3 rollout came in strong. Meta confirmed new TPU shipments, capital started shifting, and not out of AI, but deeper into AI's infrastructure layer. The ecosystem builders began attracting attention again, and that's usually a sign of a maturing, not dying trend. Zoom out further, and the macro link becomes even clearer. AI isn't just a tech story, it's a productivity engine. Studies from Anthropic suggest large language models could lift total factor productivity meaningfully over time. That one shift softens economic drag, improves output, and stabilizes liquidity conditions. And when liquidity stabilizes, assets tied to growth, like Bitcoin, tend to benefit. So now we have a paused drain, a potential liquidity rebuild forming, and a productivity backdrop strengthening. But the next catalyst isn't coming from the US at all. After Powell steps away from the microphone, the center of gravity shifts to Japan. The Bank of Japan meets on December 19th, and the stakes are far higher than most investors realize. Japanese government bond yields have been climbing rapidly, testing levels not seen since 2007. And Japan's entire financial architecture was built around decades of ultra-low yields. When yields rise quickly, the stress spreads through the system. Pension funds feel mark-to-market pressure. Insurers feel it, banks feel it, and the yen carry trade, the quiet global liquidity engine, begins to wobble. That's why the Bank of Japan or the BOJ's next move matters. If policymakers step in to stabilize yields, the yen likely weakens, sending liquidity outward. But if they do nothing and yields keep climbing, Japanese investors could pull capital home, tightening global liquidity as the carry trade unwinds. Either direction feeds directly into Bitcoin's world because Bitcoin now trades on the same liquidity tides that move equities and credit. And that takes us to the bigger picture. This is the moment when macro becomes essential. The market is trying to understand the forces that actually move prices: policy direction, liquidity flow, and global capital behavior. And right now, those forces are beginning to align. The Fed ended the drain. AI stabilized the growth narrative. Japan holds the next major liquidity lever. If these pieces move in the same direction, the entire environment could shift more quickly than most people expect. Bitcoin isn't an outsider anymore. It sits inside the global system, moving with liquidity, with interest rates, with institutional flows. The investors who understand these underlying currents tend to see the structure before the price reflects it. When macro lines up, Bitcoin doesn't follow slowly. It leads. And those who recognize the shift early are the ones who navigate the next leg of the cycle with clarity, steadily. So stay tuned, stay informed, and always keep your eye on the bigger picture. Like the video if you gained any value from today's content. Share the video with someone who needs to understand what's going on and know that now is still a good time to buy Bitcoin and get plugged in. I love you guys so much, and I'll catch you guys here in my video tomorrow. Take care.